What's up, everybody? Joseph Hadaway here, and I have officially bought every single stock in the world, and it cost me less than $5. Let me tell you how. You guys loved the dividend fire video, so we're going to do the exact same thing here, but we're going to talk about index fund fire. Can you retire early on an index fund portfolio? Best answer? Maybe. Let's look at the numbers. I want to go ahead and get this out of the way now. For all of my calculations in this video and everything I mentioned, I'm going to be using Vanguard's Total Stock Market Index Fund, or VTI, for all of the calculations, really. This is not investment advice. It just makes numbers easy, and it's a very popular fund that I see a lot of people talking about on like Twitter. And also, it's a very broad market fund holding every single US stock, and it also closely mirrors the S&P 500, another extremely popular index. One more thing. If you like the fire content, you like the investing content, you like the side hustle content, make sure to drop down and give me a quick subscribe. I'm on the road to 1,000 this year. It's my big goal for the end of the year, and I really want to hit it, and I really appreciate everyone who's helping me along the way. And yeah, let's get into it. So we got to start off with the basics. What is an index fund? Well, an index fund is in a lot of ways like a pre-built portfolio that you can buy all in one. Index funds traditionally hold anywhere from 20, 30, 40, even to the hundreds of stocks, especially if you look at like a VT, a Vanguard Total World Stock Market ETF, again, not investment advice, that holds every single stock in the world. We're getting into the thousands even. And the idea is each of these funds are broad-based across a sector or an industry, or in the case of like an S&P 500, a theoretical index that is based across several different industries, several different betas, negative, positive correlations that all add up to the same goal of diversification. The idea is kind of like if you have one stock that's down, but you have 10 stocks that are up, then at the end of the day, you still have a positive return as a whole. Now, I hear this a lot. A lot of people like to ask, well, couldn't I just make my own ETF? Couldn't I go out and pick 40, 50, 100, 200, 300 stocks and make my own ETF and accomplish the exact same goal without the expense ratio? Absolutely, you can. If you want to spend your time researching sectors and stocks that meet certain criteria or criterion that also are across several different industries, have several different returns, rates of returns, dividends, whatever it may be, I've got better ways to spend my time, and a 0.05% expense ratio on an index fund really is not a lot of money over the long term. The last point I'm going to make in this portion of the video, index funds traditionally come in two different forms, ETFs and mutual funds. ETFs being openly traded, mutual funds you have to buy directly from the issuer. You can't just buy them on the open market. They've got different rules, different regulations, different prices that I'm not going to get into in this video. I've got a whole post on my blog. You can click down in the description, read about it. And in the post, I explain why I personally much prefer to invest in ETFs, but I know it's not for everybody, or some people prefer mutual funds. Or if you listen to that personal finance guy down in Nashville, he'll tell you mutual funds is the only way to do it. But hey, your life, your portfolio, you make your decisions. I'm going to present my reasoning and what I think. And with that said, let's look at the math of an index portfolio versus a dividend portfolio. Alright, so starting off, unlike with a dividend portfolio, with an index fund portfolio, your end goal is to sell your holdings. You're going to make basically no money, if any at all, if you don't sell your index funds. So your goal has to be growth. And that's great because traditionally speaking, index fund portfolios are going to grow capital gains wise a lot faster than your dividend portfolio will. So it kind of they balance each other out pretty well. And I'm going to back this up with data. So let's just say, for sake of argument, you invested $100 a month into both VTI and VYM from January of 2013 all the way through December of 2022. What would the numbers look like? What would your fire income look like? What would your portfolio value be? Well, I ran the numbers. I went month by month. I calculated dividends. Let's see what it looks like. And before I run the numbers, I know I'm going to get some feedback on this, or some people aren't going to like it. I used VTI and Vanguard's high dividend yield ETF VYM, not investment advice, for my two numbers. I know a lot of people don't like VYM, some people don't like VTI. This is an educational channel and an educational video. These are two funds by the same company with clearly stated investment objectives. It makes the math easy, it makes the math work, and again, it's educational. So let's get into and see what the numbers look like. All right, first up, I ran the numbers on VTI. Let's see what they look like. Kind of just basically as a whole, if you took a $100 contribution every single month for 10 years into VTI, you invested a total of $12,000 into the fund. So I ran two calculations. If you invested $12,000 on January 1st, 2013, as well as if you invested $100 a month from January 2013 all the way through December of 2022. And well, how were you looking in January this year? Start off with VTI. Of course, you got some solid dividends throughout the year, but your main form of growth was capital gains, starting with a share price in the 70s, coming up all the way into 2023, January 1st, share price to slightly over $200. All the way in 2022, the share price was upwards of $200. That means the shares you bought in January are now worth almost triple the value 10 years later. So that's insane growth right there by itself. As a whole, if you put $100 every single month into VTI for 10 years, your portfolio value on January 1st, 2023 would have been right around $21,148.98. And I did manually calculate all of these dividends as well. If you use the 4% rule, which I might make another video about, let me know down in the comments if you want to see that, your strict income just from selling your holdings would be $845.96 per year. Not bad. And then what I did is I took your portfolio value on January 1st and backed out that $845. Then if you use VTI's current dividend ratio of 1.6%, or I should say dividend yield rather, you get another $324.85, coming up to a yearly income of $1,170.81 just from that $100 a month being invested, which is not bad, I gotta say. $1,100 a year may not sound like a lot, and truly it's not. You're not going to retire early on it, but as we've discussed before, if you're going to retire early, you've got to go above and beyond. What is that thing Dave Ramsey likes to say? You have to live like no one else so later you can live like no one else kind of thing. All right, so let's see how VYM compares. All right, so now we're on to VYM. So this is a dividend-heavy ETF. It's Vanguard's high dividend yield ETF. I think I said that earlier. If I did and you weren't listening, here it is again. So you're going to get a lot more dividend growth, of course, over 10 years. Your share price growth is still pretty significant, starting right here at a little over $52 as of January 1st, 2013, and getting up to $110 as of January 1st, 2023. Called about your share price doubled over 10 years, which along with constant dividend growth as well, because if we even go through and each year your quarterly dividend started about 36 cents a share back in 2013. It went up, it went down, it went up, it went down, but it's been a pretty solid trend up, whereas the Q4 dividend in 2022 was almost $1 a share. So that is that 3 times growth we saw with VTI, but in dividend form. Of course, like we talked about before with VYM, if you're looking for income from it, you're probably never going to sell it. You want your primary income source to be those dividends, those distributions from the fund, which if you haven't seen it, go watch my dividend video. I've got a whole rant about that. So that same $100 a month would have turned into $20,482.52 as of January 1st, 2023. A slight drop from VTI, but the income number doesn't quite hold up as much. So if you're not looking to sell VYM at all, on their current dividend yield of 3.13%, and I know I pulled this dividend yield in April, the fund is down 0.62% this year. They're basically the exact same that it would have been on January 1st. You're going to have a total yearly income right now of $641.10, which is, call it a little more than half of what you would have gotten from the exact same thing from VTI. But again, you don't have to sell. There are higher yielding funds out there, but do your research, build your own portfolio. So the last point I really want to make on this is also I ran the numbers on if you invested $12,000 strictly into each fund as of January 1st, 2013, your VYM would have only grown to about $25,479, whereas your VTI would have grown to over $31,750. So that illustrates the capital gains growth a lot better than the DCA is, but again, DCA is probably a more realistic way that most of us are going to invest. So in conclusion, more income from the index fund faster is the same 10-year period. I mentioned the dividend video. It's about twice the amount in the portfolio to get the same income, but you also have to sell your holdings to make that work. So now that we've looked at the numbers, we've got to talk upsides and downsides. What makes the index portfolio good? Where does it fall short? How does it overall compare to the dividend portfolio away from just numbers? Well, for starters, I did look this up, I did the research, and dividends and capital gains are basically the exact same in terms of tax laws. In 2023, if you live here in the good old US of A, of course, tax laws can change year by year, this is only relevant for 2023, a single individual can bring in up to $41,000 in either capital gains or dividends or a combination of the two and pay a 0% tax rate. Pretty good, 0% taxes. It's a lot less than I'm paying on my W-2 income. Whereas a married couple can double that and make up to about $83,000 before they have to pay any taxes. As well, capital gains taxes are capped at like 15-20% depending on how much money you're bringing in from capital gains every year. So overall, it is a more effective tax vehicle than, say, a W-2 job is. And I feel like I've said this 20, 30 times in this video at least, a huge perk. Your index fund portfolio, especially over the long period, is going to grow faster than a strictly dividend portfolio would. But that does come with the downside. Once you reach FIRE and you are selling your index fund portfolio for income purposes, you become a little more susceptible to a market downturn than you do with a dividend portfolio. And I can explain that real quick. With a dividend portfolio, the value of the portfolio doesn't really matter as long as you're holding quality stocks and funds, because the value doesn't affect the dividend. All you really care about is the amount of money you're bringing in from the portfolio. So your value and your cash flow are basically separate metrics. Whereas with your index fund portfolio, your value and your cash flow, since you're selling a portion of your portfolio every year, are the exact same number in a lot of ways. They go hand in hand. You can't have one without the other. So in the event of a market downturn, your index fund portfolio, a little worse than your dividend portfolio. Once again, like I've mentioned several times before in this video and most everything else I do, the upside is you don't have to pick just one investing option. Index fund portfolios are great. They're fantastic. I hold index funds. Highly recommend. The capital gains growth you're going to get is ridiculous. And then you add on the idea of selling options and other things like that, and it's pretty nice. There's definitely some more content to be made on index fund portfolios that I may talk about here. I may talk about in my blog. Check out my website for my blog. I'm trying to post every week. I think I'm at like 4 posts this year, so maybe it's monthly. Either way, more how-to and about posts coming pretty soon on like how to make extra money out of an index fund portfolio. You know, moving on from that, like I said, I hold index funds. I hold dividend ETFs. I hold a couple individual stocks, very, very few. And I'm investing in real estate, like you saw the video about the house that I'm standing in right now. You don't have to pick just one method to reach FIRE. In my opinion, it's honestly better to diversify your income streams, come up with a little bit of everything, because like I hold all three, and in a lot of ways I'm getting the best of all the worlds, getting the best of everything. And you can do the same. There's absolutely no need to limit yourself to just one idea or one strategy, because hey, there's benefits and downsides to absolutely everything. As always, thank you all so much for watching. If you like this kind of content, maybe consider subscribing. I'm on that road to 1K. It's my big goal for this year. I really want to hit it. Follow me, Twitter, Instagram. Like I said, read my blog. Check it out. I got a lot of content coming out. Check out my podcast over at Strive to Fi. Thank you again all so much, and I'll see you with another video next week.